If you're looking at a business to buy, don't skip over the balance sheet. Now, most people, myself included, we go straight to the income statement. We try to see how much cash this business is generating, which is fine, but just make sure that you don't skip the balance sheet before you make an offer on the business. Now, when looking at the balance sheet, I think the first thing you want to look at is just look at the fixed assets. Try to get an idea of the physical assets that you're buying. And really where that comes into play is one, you can see whether you're actually getting some assets or not. But two, you can evaluate your tax situation because you're gonna be able to depreciate those assets in year one. So the more assets, the bigger the tax benefit. But that also means the more assets the business has, the more you're gonna need to spend on assets every year. So CapEx or capital expenditures. So when you're modeling out your cash flows, business with more assets, it's gonna have more CapEx. So you need to go to the income statement and subtract out what you think a reasonable amount of annual CapEx is. And the best way to get a guess at that is from the value of the assets on the balance sheet. And of course, when you're looking at those values on the balance sheet, those are accounting values, not the market value or the economic value. So just keep that in mind, but at the start, it's all you've got, it's the best you've got. And then one of the most important things when looking at the balance sheet is figuring out the working capital needs of the business. Now, the working capital is just the cash that you need just to keep the business alive. And the simple formula for that when looking at the balance sheet, it's just the accounts receivable plus the inventory minus the accounts payable. Keep in mind, as those people that owe you money and haven't paid yet, that means you've already realized the expense for that job, but you haven't realized the cash, hence the need for the working capital. You need the cash to pay for the work to be done while you're waiting for a customer to pay you. And then the inventory, you have to buy inventory ahead of time, so that'll give you a good idea of what you need. And then the accounts payable are, how long do you have to pay people who do service for you? So if you buy something from your vendor and you have 30 days to pay them, right? Then you can maybe do work for a customer, and as long as the customer pays you within 30 days, basically the customer can handle your accounts payable. So you're looking at that balance sheet to figure out the working capital need. And that's really important to do before you make an offer, because that working capital need really comes into the economics of the deal. So some businesses need practically no working capital. Some businesses need a lot. So say a business touches the oil and gas industry. Those companies pay on a 90-day cycle, or if you do work for the government pays really slow. You're gonna need a lot of working capital. So you might have $1.5 million business that you're buying, but it might need $1.5 million of working capital. So really the economics of the deal is it's a $3 million deal. You need to make sure that it works at a $3 million valuation, that you can make the cash flow work. You need to figure out where you're going to get that working capital. Banks will typically lend you up to $500,000 of working capital. Anything you need beyond that, you need to work out with the seller in a way to keep the accounts receivable and kind of negotiate it into the overall deal price. Because you really don't want to have to come back and renegotiate the deal because you didn't take the working capital into account when making your offer.